In this video, we learn how to choose the optimal capital structure for a firm, covering both theoretical and numerical aspects of this policy decision. The policy question, as we know from our previous two videos, is: does debt create value? It is also important for investors to know if investing in a leveraged firm yields higher return than investing in an unleveraged firm. We covered the responses to this policy question in our previous two videos of this series. In 1958, proposed that when there are no taxes, the value of a levered firm is equal to the value of an unlevered firm, and the cost of unlevered equity is equal to the cost of capital of leveraged firm. So the conclusion is that debt does not create value, and hence capital is irrelevant, as investors are indifferent between investing in leveraged and unleveraged firms. In 1963, in their second paper, they proposed that the value of a leveraged firm is higher than the value of unleveraged firm, provided there are corporate taxes. The value created by debt is the value of tax shield on interest expenses. Hence, the conclusion was debt creates value when there are taxes, and capital structure is relevant in investment decision making. Even with corporate taxes, the theory was criticized for its assumption of unlimited borrowing at the risk-free rate by both corporations and individuals. Hence, no chance of bankruptcy and no bankruptcy costs. As there is no chance of bankruptcy in the world with corporate taxes, because borrowing can be done at the risk-free rate and unlimited amount of money can be borrowed, the policy implication for the firm is that it will continue to substitute debt for equity, leading to 100% debt financing by a firm, which we know is counterintuitive. In that case, creditors will become the shareholders of the company automatically. The static trade-off theory is the alternative theory of capital structure that accounts for both the benefits from borrowing as well as the bankruptcy costs involved in borrowing. It relaxes the assumption of risk-free borrowing in addition to allowing for corporate taxes. It is also known as the Harvard approach to capital structure. Corporate borrowing as well as personal borrowing is not risk-free, and both corporations and individuals cannot borrow unlimited amounts of money at the risk-free rate. For corporations, if borrowing creates value in the form of tax shield on interest expenses, it also leads to bankruptcy costs that arise from borrowing. So, if a company borrows more and more money, it will increase its financial risk, and it will also lead to higher bankruptcy costs. The higher is the borrowing amount, the higher will be financial risk, that is the risk of the company becoming bankrupt. Therefore, if borrowing on the one hand has benefits in the form of tax shield on interest expenses, it also has bankruptcy costs on the other hand. The static trade-off theory implies that a firm will continue to borrow more and more money as far as the marginal value of the tax shield from borrowing is greater than the marginal value of the bankruptcy costs. The level of borrowing at which the marginal value of the tax shield exactly equals the marginal value of the bankruptcy cost is the optimal capital structure for the firm. Above this level of borrowing, the marginal value of the tax shield becomes lower than the marginal value of the bankruptcy cost. Now, this is what we are going to numerically illustrate with an example. For our example, let's assume that the risk-free rate is 4%, the market risk premium is 6%, the unlevered beta is 0.9. This is the beta of the firm if it has zero debt in its capital structure, that is 100% debt financing. Let's assume the tax rate is 40%. Earning before interest and taxes of $5,000, no PAT, that is net operating profit after tax $3,000, which is 5,000 multiplied into 1 minus 40%, and then we are assuming net investment of 0 and the free cash flow to the firm equal to 3,000 as we did in our previous two videos. Like the theory, we are assuming zero growth rate, which implies that all earnings are paid out as dividend. There is no net investment in fixed assets and working capital, and the NOPAT of the firm is equal to the free cash flow of the firm. The number of shares outstanding is 10,000. In addition, assume that for the different levels of borrowing, we have the cost of debt available as per this schedule here. So you can see that as the firm borrows more and more, the cost of debt is rising with the level of borrowing. This is reflecting the financial risk of the firm, as the lenders will demand a higher rate on their loans or debt to the firm. The weight of debt here in this column is a percentage of the market value of the firm. So this is not the book value weight, but the market value weight of debt in the capital structure. Now the question is, how would we know that a given mix of debt and equity is the optimal capital structure? We know that at the optimal capital structure, the marginal value of the tax shield should be equal to the marginal value of the bankruptcy cost. However, we need simple rule, and the simple rule is that the optimal capital structure minimizes the WACC, which also implies that the value of the firm will be maximum at the optimal capital structure, which also implies that the share price will be maximum at the optimal capital structure. We will verify these three numerically, and we will also have a look at this complex rule in our numerical example. So the optimal capital structure will minimize the WACC, maximize the value of the firm, and maximize the share price. We are given the unleveraged beta of the firm to be equal to 0.9. To calculate the leveraged beta, we will be using the Hamada equation, which is given as the beta of the leveraged firm is equal to the beta of the unleveraged firm into 1 plus 1 minus the tax rate into debt divided by equity. Using the Hamada equation, we will be estimating the leverage beta, which we will be then using to calculate the cost of equity using the capital asset pricing model, which is KL is equal to the risk-free rate plus the leverage beta of the stock into market risk premium. So these are the models that we are going to use to calculate the leverage beta and then to calculate the cost of equity using the capital asset pricing model. The formula for the WACC will be the cost of debt of the firm into 1 minus the tax rate. This will give us the after-tax cost of debt, which we will multiply into the weight of debt in the capital structure plus the cost of levered equity multiplied into the weight of levered equity in the capital structure. We start with the calculation of the WACC, as we know that the optimal capital structure is that at which the WACC is minimum. So for the different capital structures under consideration, we calculate the WACC and we find that the WACC is minimum when the company borrows 30% and finances 70% through equity. At that point, the WACC is 8.81%. This column here is the debt to equity ratio, but this is not the book value of debt divided by the book value of equity. Rather, it is the market value of debt and market value of equity that is used to calculate the debt equity ratio here. Then in this column, the after-tax cost of debt is calculated, which is the KD multiplied into 1 minus the tax rate. So 5% into 1 minus 40% gives us 3%. The after-tax cost of debt for the other levels of borrowing are calculated in the same way, multiplying the cost of debt for that level into 1 minus the tax rate, and we obtain the after-tax cost of debt for their respective levels of borrowing. The leverage beta here is calculated for each level of borrowing using the Hamada equation. When the firm borrows 10%, its leverage beta is 0.96, which is calculated as the unleveraged beta, which is 0.9 into 1 plus 1 minus the tax rate, which is 40%, multiplied into 0.11, which we obtained here, dividing 10% by 90%. So this gives us the leveraged beta at this level equal to 0.96. Similarly, the other betas are calculated repeating the same procedure at each level of borrowing. The cost of levered equity is then calculated using the capital asset pricing model. So here the cost of levered equity when the firm borrows 10% is equal to the risk-free rate, which is 4%, plus the beta of the firm at this level, which is 0.96, multiplied into the risk premium, which is 6%, and this gives us a total of 9.76% as the cost of equity when the firm borrows 10%. The same is done at this level, and the other levels. Alternatively, you can use the model with corporate taxes to calculate the cost of levered equity, as the cost of levered equity is equal to the cost of unlevered equity plus the cost of unlevered equity minus the cost of debt into 1 minus the tax rate into debt divided by equity. So if we use this, we have the cost of unlevered equity equal to 9.4% plus 9.4% minus 4% the cost of debt, which is the risk-free rate here. 1 minus the tax rate is equal to 0.6, and debt divided by equity is already 0.11. If you solve this, you will get the same 9.76%. So you can either use the model for the cost of levered equity when there are corporate taxes, or you can use the CAPM, and they should ideally be giving you the same number, that is 9.676% and 9.76% here. Using these inputs, now we can calculate the VAT at each level of borrowing, and from this column we see that the VAT is minimized when the firm borrows 30% and 70% is equity. That is, VAT here is equal to the after-tax cost of debt, which is 4.2%, multiplied into 30%, which is the amount of borrowing, plus the cost of equity, which is 10.79%, multiplied into the weight of debt, which in our case here is 70%. So if we solve this, we get it equal to 8.81%. This is the minimum WACC, and it indicates, as per the rule, that this is the optimal capital structure of the firm. This chart here shows the behavior of the cost of capital, the cost of debt, and the cost of equity as the firm borrows more and more money. So we see that both cost of equity and cost of debt are rising as the firm borrows more and more. However, the wake of the firm first starts dropping but then rises after it reaches the optimal capital structure level here. After this point, the marginal value of the tax shield from additional borrowing is less than the marginal value of the bankruptcy cost. The result is that the WACC starts to rise again. Next, we see which capital structure maximizes the value of the firm and the share price. We already know that 30% borrowing and 70% equity financing results in minimizing the WACC, which is 8.81%. To get the value of the firm, we will use the free cash flow to the firm. We already know that the firm has zero growth and is investing zero money in net fixed assets and working capital. The result is that no PAT of the company is equal to the free cash flow of the firm. So we divide the free cash flow of the firm by the WACC of the firm. So 3000 divided by 9.4% gives us the value of the firm here. That is, value of the firm is equal to 3000 divided by 9.4%. Remember, the value of the firm is a combination of the value of equity and the value of debt. So the value of debt in the first case is 0. So the value of the firm will be equal to the value of equity. In the second case, again, our cash flows are the same because we are keeping all other things constant. The only difference is now the firm is borrowing, and as a result, its WACC has gone down to 9.09%. So the value of the firm will be 3,000 divided by 9.09%. So the value of the firm is $33,003.3. The weight of debt and the weight of equity will be used to calculate the value of debt and the value of equity from the value of the firm. So 10%, that is the weight of debt, multiplied into the value of the firm will give us the value of debt, and 90%, that is the value of equity, will be calculated as the value of the firm multiplied into the weight of debt. To calculate the values of share price here, we are assuming that the amount borrowed will be used to buy back shares of the unleveraged firm. That is, any amount that we are borrowing here will be used to buy back the shares of the company when it is not borrowing anything that is unleveraged. This is because the firm has no need for investment and growth rate is 0. Therefore, any increase or decrease in value of the firm will result in increasing the value of all shares before the buyback. So we divide the value of the firm by the original number of shares to get these values here. We illustrate this next in our calculation. For now, the value of the firm divided by 10,000 gives us the share price, and we are doing the division by the original number of shares, and we are not dividing the value of equity that we have in this column, but we are dividing the value of the firm here in this column by the original number of shares, that is 10,000, to get these numbers. So for example, this number here is obtained dividing the value of the firm by 10,000. So that is equal to $3.4 the share price at this capital structure. This chart shows how the value of the firm first increases, then decreases as the firm borrows more and more of debt. The optimal capital structure, as indicated here, is around 30%. The value of equity is declining as the firm is borrowing more and more, and the value of debt is increasing as the firm is borrowing more and more. As per the rule, the value of the firm is maximum at the optimal capital structure, which we identified to be 30% debt and 70% equity. Now we show that the value of the firm is a combination of the value of debt and the value of equity. That is, the value of debt plus the value of equity is equal to the value of the firm. So we value the debt of the firm and we also value the equity of the firm separately and then add them up to confirm that they both are equal to the value of the firm. So here we have the cost of debt given in this column for the different capital structures, and we have the cost of levered equity calculated for the different capital structures. We have the interest expenses here, which are calculated as the cost of debt multiplied into the value of debt from our previous slide. The interest expenses are calculated for each capital structure, and we see the higher is the level of borrowing, the higher are the interest expenses. The free cash flow to equity are calculated as free cash flow to equity is equal to NOPAT minus after tax interest expenses, which is interest expenses into 1 minus the tax rate. So in our case here, in the first example, 3,000 is NOPAT, interest expenses are 168.32, multiply them by 1 minus the tax rate, that is 0.6. So we get it equal to 2,899.01. The value of equity here is then calculated as the free cash flow to the firm, which are 2,899.01 divided by the WACC, which is 9.76% here. Remember, growth rate is 0, so we are not included it here in our calculation. The value of equity plus the value of debt gives us the value of the firm. Now keep in mind that our job is to maximize the value of the firm, not the value of equity. So you see, when the value of the firm is maximum, the value of equity is not maximum. This is what you need to be very careful of. The job is not to maximize the value of equity, but to maximize the value of the firm. On the previous slide, we first calculated the value of the firm, discounting the free cash flow to the firm by the cost of capital, and then we calculated the value of debt and the value of equity, multiplying the weight of debt and the weight of equity into the value of the firm. Here we are doing it in reverse order. So we are calculating the value of debt and the value of equity using their corresponding cash flows and discount rates, and then we add them up to get the value of the firm, and we confirm that the value obtained in this column here match the value obtained for the value of the firm in the previous slide. Now we look at the share prices at different capital structures. We already know that the share price is maximum when the firm borrows 30% and 70% is equity financing. Now let's confirm that in more detail. So this column here is the earning before interest and taxes, and we are keeping it constant. The interest expenses at each capital structure are given in this column, and then the earning before taxes is earning before interest and taxes minus interest expenses. This column minus this column is equal to this column. Taxes are 40%, so 40% multiplied by EBT. So this column is 40% multiplied into this column. Net income is then earning before taxes minus taxes. So we have net income here. And as we know that the company will pay all its earning as dividend, so the net income that is in this column, all of it will be paid out as dividend. So earning per share can be calculated, which will be also equal to dividend per share, net income divided by the number of shares outstanding. So in the first case, we have 10,000 shares outstanding. So that will be equal to 3,000 divided by 10,000. So earning per share, which is also equal to dividend per share, will be 0.3. The cost of levered equity is 9.4%. Of course, this is the cost of unlevered equity because here we have no borrowing. So be careful with this. This is the cost of unlevered equity. So 0.3 divided by 9.4%. This gives us the share price when the company borrows nothing, that is unleveraged. $3.19 is the share price. Here we are assuming zero growth, so we are using the dividend discount model to value the share price. So this is dividend divided by the cost of equity, and that is giving us $3.19. We know from the valuation of the firm table that the value of the firm when it borrows 10% will be equal to 3,000, which is the cash flow to the firm, divided by 9.06%, which is the WACC of the firm when it borrows 10%, and the value of the firm will be equal to 33,003.3. Because debt was 10%, so the value of debt was $3,300.33. We know that the share price in that case was calculated dividing the total value of the firm by the original number of shares, which was equal to 10,000. So it was equal to 3.30. So we have the share price when the firm borrows 10% equal to 3.3. Now how many shares can be repurchased if the company is borrowing $3,300.33 and one share can be purchased for $3.3? So this will be equal to $3,300.33 divided by the share price, which is in this case equal to 3.3, and this gives us around 1,000 shares. So if the firm borrows $3,300, it will be able to buy back 1,000 shares, which will leave 9,000 shares outstanding in case the company borrows 10%. Now the earning per share here will be calculated dividing net income here by 9,000, which is the outstanding share, and this will also be equal to the dividend per share because all the earning are paid out as dividend. So dividend per share divided by the cost of equity gives us $3.3, the same number as we obtained in the table on the valuation of the firm. The remaining calculations will follow the same procedure. So you calculate the value of the firm and then calculate the price per share dividing the value of the firm by the number of shares, and then determine how many shares can be repurchased. So for example, here in this case, the borrowing is equal to 20% of the value of the firm. So 20% of the value of the firm divided by the share price, which will be 3.39, that will give you 2000 shares. So the number of shares here will be equal to 8000 then, and then dividing the net income by the outstanding number of shares if the company borrows 20% is equal to 0.35 EPS, which is also equal to the dividend per share. As we see here from this column that the share price is maximized at $3.4 when the company borrows 30% and is 70% equity finance. So now we have seen that the optimal capital structure is the one that minimizes the WACC, that maximizes the value of the firm and the share price of the firm. This chart shows the share prices for different capital structures, and we can see here that the share price is maximum when the value of debt is 30% of the total value of the firm. Finally, we compare the value of tax shield and the value of bankruptcy cost. Now to do this, we deduct the value of the unlevered firm from the value of the levered firm that we calculated following the static trade-off theory. Here we have the difference between the value of the levered firm and the value of the unlevered firm. You can assume this to be equal to the tax shield minus the bankruptcy cost. This is the value of the tax shield, and we calculated this in line with theory, assuming no default. So this is equal to tax rate multiplied into the amount of borrowing, that is debt. So bankruptcy costs are estimated here as tax shield minus the value of the levered firm minus the value of unlevered firm. That is the difference between the two valuations of the firm. The change in tax shield or the marginal value of the tax shield is calculated as this value minus this and this value minus this for each successive capital structure. Similarly, the change in bankruptcy cost, that is the marginal value of bankruptcy cost, is calculated as the difference between this minus this value and this minus this value. So it is calculated for each level of capital structure except the first one, which is the start. As we discussed, at the optimal capital structure, the value of the marginal tax shield should be equal to the value of the marginal bankruptcy cost. We see this is not the case here. However, the marginal value of the bankruptcy cost is higher than the marginal value of the tax shield when we move to 40% borrowing and 60% equity. At 30% borrowing and 70% equity, we see that the marginal value of tax shield is still higher than the marginal value of the bankruptcy cost. It means that the optimal capital structure is somewhere between 30% and 40%, where the value of the tax shield will be equal to the value of the bankruptcy cost in marginal terms. Therefore, note that the optimal capital structure that we choose also depends upon the interval that we take. So here, for example, we are taking a 10% interval. So we move from 0% to 10% borrowing, then from 10% to 20% borrowing, and then from 20% to 30% and onward. So the choice of the interval that we take to assess the optimal capital structure also plays an important role in choice that we make at the end of the day. This chart plots the values of the marginal tax shield and marginal bankruptcy cost, and we clearly see that the appropriate optimal capital structure is somewhere between 30% and 40% as these lines cross each other at this point.